Welcome to Chit Chat Stocks. This is our weekly Power Hour episode. We have changed the time up. If you're listening to this live, it is 5 o'clock Eastern time on Thursday, 2 o'clock Pacific time as well. And we've got plenty to talk about this week. Netflix just reported earnings. We have Hermes earnings. We've got American Express, IBKR, Taiwan Semiconductor, plenty to get to. We also have some controversial news. Tariffs, of course, are in the news again. So we're going to rip through all of that. But before I do, I should say I am joined, as always, by Brett Schaefer. Brett, how are you this morning? / afternoon.
Feeling good. Not this morning anymore. Afternoon. Let us know, guys, again on that volume. I think we're okay. I might turn myself down a tad, but unfortunately, given all the pros they have at Windows, they seem to change my input volume on every Windows update. Good for them. Seems like they're really winning the AI race. But yeah, excited. I mean, we're back, hopefully off tariffs. People actually asked us explicitly that we could do something besides just the endless tariff, the endless trade wars. So I think given that earnings season has started, we got plenty to talk about. Some very interesting companies we've followed for a long time. And I think, maybe some potentially good buys post earnings.
Correct. Potentially. We can leave it at that. But before we get to those earnings, we want to talk about our friends at Interactive Brokers. Interactive Brokers is the professional's gateway to the world's markets. Interactive Brokers offers commissions starting at $0 on US listed stocks and ETFs with low commissions on other products, and there are no added spreads, ticket charges, or account minimums. Clients in over 200 countries and territories trade stocks, options, futures, currencies, bonds, funds, and more on 160 global markets from a single unified platform. Clients earn interest rates of up to 3.83% on instantly available cash and pay margin rates up to 53% lower than the industry. You can also earn extra income on your lendable shares, and IBKR's powerful award-winning trading platform helps every level investor succeed from beginner to advanced on mobile, web, and desktop. When placing your money with a broker, go with a broker you can trust. Make sure your broker is secure and can endure through good and bad times. We use IBKR here at Chit Chat Stocks for their best-in-class international coverage, and you can too by heading on over to ibkr.com. Interactive Brokers is a member of SIPC.
Have you
Brett,
officially made the switch to IBKR, Ryan? Did you do it?
yes. Well, not everything, but yes, I have moved some over. IBKR is nice. It is wonderful. Not only, I am not just saying that because they're an advertiser. Um, they are phenomenal for international stock trading and lots of other things as well. The instantly available cash, the 3.83% on that is really nice. But we're going to be talking a little bit more about IBKR here in a second and all the accounts they are adding. A little foreshadowing there for their earnings discussion because they did report earnings, I think, yesterday morning, maybe Tuesday. Could be getting the timing wrong there. But Brett, where do we want to start? Netflix is kind
Let's
of
do Netflix. Yeah,
okay.
Netflix. I haven't even looked at all. Honestly, I was at the gym. No big deal. Before this recording, you got some numbers here, so I guess we can react live. They just reported. What would it be? Less than an hour ago at this point.
Yeah, well, I guess let's start with a rest in peace to one of my favorite KPIs of all time, Netflix's memberships. They no longer are reporting memberships or average revenue per membership, which is just so sad. So,
Yeah,
so
your
sad.
charting. Your charting running the FinChat account is gonna take a hit because every quarter you run that number for for everyone, right?
Everyone loves that KPI. I mean, you know what's sad is like, it's not like it's being replaced by other relevant KPIs. And it's not to the point where it's like, so they're talking about like, oh, average memberships in and of itself is not the metric to follow. But they also brag that their ad supported tier. So that was kind of why they did it, I believe. It was because there's the ad supported tier and then there's the premium subscriptions tier. And so, like, you're getting memberships that aren't necessarily equal in value. But then they brag that their ad-supported tier can actually close the gap on monetization despite being a lower subscription price point because they get all the ad revenue. So I'm thinking if they can be similar value, why not just keep reporting it? Now, part of that was they said by the end of the year, it'll be similar value. I'm curious if there's something else here, if they just don't want people to know how many members they have. But I find it incredibly disheartening.
All right, let's get into the numbers. How is the report? Looks like the stock is breaching $1,000 a share after hours, Ryan.
Yeah,
Wow.
it's up like 4%. Everything looked good. Revenue grew 15%. Operating income grew 27%. Um, there wasn't any surprises, I'd say. They're buying back stock as well, which is nice.
Maybe.
Maybe. Yeah, I
Maybe.
guess. Uh, they are investing a lot in live events, but this is kind of something we already knew. In Q4, we saw the impact of the NFL games. What other live events do they have? They did like the roast of Tom
WWE.
Brady.
Oh, the roasts. Yeah. They've done some weird golf events. They're trying to do some one-off stuff because they can't get full sports rights. That's a slower game. So, hey, seems like it's working, at least so far. What's weird about Netflix is they're doing so well, but I've never felt less inclined to subscribe. I'm not a subscriber right now. I don't feel any need to, except for if a sports team I follow is going to eventually watch an important game, or excuse me, exclusively have a game on there, like the Christmas Day or something like that.
Yeah, I don't know. I've kind of always felt like that with Netflix. Like it's never for me, it's never like the go-to content that I want, but I mean, it's never affected them. They have
They
enough
seem to be doing
content
just fine.
to satisfy a whole bunch of different interests. I'd say the biggest news piece here is they will now have WWE live events 52 weeks a year. They said our live event strategy is unchanged. We remain focused on breakthrough events that our audiences love, and any rights or event deal we pursue has to make economic sense. Not totally sure how they calculate whether or not it makes economic sense, but I mean, look, you get people. This is a great way to get new subscribers. Like anyone that wants to watch WWE, this is great, and then you keep them uh, with your original content, which is higher margin. So yeah, I mean I think the blueprint they laid it out last quarter, which it's pretty clear. I think you can supercharge member growth, even though we're not going to see that because they stopped reporting it. You can supercharge member growth with these live events, get people into the platform, and then you can hopefully keep them with continuous content. And it seems like that totally worked. If we're using last quarter's data, I think they reported their highest membership, single quarter membership growth ever last quarter. Um, the only bummer here is there just isn't a whole lot of visibility to talk. Like there isn't a whole lot to talk about beyond sort of the top line numbers anymore. Like revenue, operating income. That's basically what we're going to be measuring them by from this point on, because we don't know like what percentage of revenue is coming from ad supported versus subscription, that kind of thing yet. They do seem to have big ambitions to continue to roll out their advertising business. They talked a lot about some of the tech developments going on there, but yeah, in general, I'd say really no surprises. Top line, bottom line numbers look good.
Yeah, when
Boring.
it is almost boring at this point. I wouldn't be anyone that says the reinvestment runway is over. I still think there's plenty of room to grow subscribers and just viewing time internationally in plenty of different markets. Now, North America might be more of a, all right, let's get some more sports, let's get some more exciting stuff to get people more coming back to the platform, and adding on those, the advertising tier could hopefully turn it into I don't even know, like just a better advertising platform to just monetize that existing North American subscriber base better, where they're not going to grow subscribers from that much. I thought it was interesting 3 days before the earnings, and I'm pulling this up right now. They must have It must have been leaked from the company. I don't know why someone from the Wall Street Journal would be trying to steal this from them. It must have been leaked from Netflix itself. It says Netflix aims to join the $1 trillion club. They shared, this is sourcing, they share with senior staff ambitious goals for revenue, ad sales, and operating income by 2030, according to the people who attended the meeting. They aim to double revenue from $39 billion last year, so that would be about $80 billion, and earn about $9 billion in global ad sales. And what was the number on? Yeah, here it is. Tripling operating income by 2030 from $10 billion last year. So that would be $30 billion. And that's what? This is about 5 years from now, give or take. After hours, it looks like we're at about a $430 billion market cap. If you think that operating income number is achievable, you probably hold on to your shares here. But I think it's hitting the never sell zone where you're not buying, but you're not selling. Like, I mean, if this has been a big winner for you, just keep holding. But am I
Yeah.
buying here? No.
Yeah, I agree. And why did this need to be reported by the Wall Street Journal? Was this
Well,
the
it's
just
because Netflix leaked it to them. And
I know, but like, why did if you're Netflix, was this just like the cheaper alternative to having an investor day? Like,
I
oh, you know
guess,
what? We don't need to have an investor day. Let's just give our forward estimates or our forward hopes to Wall Street Journal
yeah,
and let them publish an article on it. It, yeah, those numbers seem achievable. I don't see what stops them from getting there. But look, when you say those numbers seem achievable, and if they do achieve it, you would get an adequate return. I don't want
probably.
like, yeah, I don't want like potentially achievable and adequate return. I want it the other way. Like those, like the goals are very, it's a low bar and you can still get good returns on a low bar. But with that said, yeah, I think this is, I really, over the last, I'd say year or two, have kind of come to appreciate how competitively advantaged they are. Um, and I mean, it seems like at this point, streaming wars are over. Uh, Disney
It's
ruined their
YouTube's
chances.
it's yeah,
Yeah,
those companies are done. The Netflix, YouTube, Spotify, and here's my dark horse for 2025. And it might not be too meaningful, but I am going to be fascinated to see how with the Switch 2 and Grand Theft Auto 6, is it? Would they come out if video games finally make a comeback? Because that industry has just been in the doldrums for years. They're competing for time spent. You know, if we get these games coming back, some of these flagship ones, hey, maybe that impacts time spent on the platform because that's what they're competing with at the end of the day, all forms of entertainment. Let's move on to another topic, though. We have a question from the audience from Tyler. Welcome back, Tyler. Thoughts on here's two ones we can hit together because they kind of relate. Thoughts on Amazon given Temu and Shein's demise, and thoughts on the divergence between big tech, Meta, Amazon, Google, TSMC, and Microsoft earnings growth, which is growing at 30% versus the stock price is down 30%. I would say for people just think forward earnings are going to go fall off a cliff. For example, Temu and Shein are huge advertisers on Google and Alphabet properties as well as Meta properties. Well, they were until 2 weeks ago when that dried up entirely. And I think Temu and Shein, I guess we don't need to go to the details, but the de minimis stuff is gone. The tariffs are totally blockading this from happening. The business models might be totally broken for both Temu and Shein, at least at the moment, unless something changes as it has been rapidly. And I think that could impact the earnings growth there. Now, TSMC, that's a little bit different. I have the earnings right up in front of me. I mean, I think they are turning into more of an AI play. 59% of their revenue last quarter came from high performance compute. So maybe people are just a little bit tepid on what the AI earning or AI revenue growth will be going forward. Although I did see that they are reportedly raising prices by 30%, which is nice because there's probably no talks of going anywhere else. And then Microsoft, Amazon definitely has a ton of exposure to the Chinese supply chain. So I'm sure people are going to be worried about that. Advertising as well. Those Chinese sellers are advertising on the platform. Now, AWS and Microsoft Azure, I know I'm kind of all over the place here, are still growing quite quickly, but for the most part, I understand the big tech drawdown. What do you think?
Yeah, I think the big tech drawdown, when you look at each company individually, makes sense. Amazon especially, obviously the supply chain exposure. We're talking about Temu and Shein. Uh, I haven't really looked. Well, I don't think Shein's public, but Temu, I actually, if I'm not mistaken, they have a really big business in China, like customer wise,
Yeah,
beyond
Pinduoduo. Yeah,
the.
same company.
No, I mean like Temu has a lot of like a lot of people I think of Temu as buy cheap Chinese Americans buying cheap Chinese goods. I think there's a lot of Chinese customers buying cheap Chinese goods. So I don't think it's like
Wait. In China? I mean, it's the same concept, but like it's a different name. I mean, it's called Pinduoduo.
oh wait, so Temu's specifically only on a
Internationally,
okay,
yes.
okay.
It's kind of like the TikTok naming. It's like a similar concept,
Oh,
but
just
it's
okay.
just called something different.
I would be curious to split between the American buyer and the Chinese buyer for that business. Because if the Chinese buyer, if you're open to buying Chinese stocks and Chinese customers make up a big chunk of Pinduoduo's revenue, you might not be too affected by
Perhaps.
the tariffs. But obviously, if Timu's big business for them, then maybe not.
I also saw that their profit margins on Temu, this was a while ago, given the advertising spend was like negative 50%. So maybe this will be a big earnings bump for the company. Like they won't be trying to attack Amazon's moat for no reason. I think over the long term, Amazon will be fine because they can adapt. If unfortunately a bunch of small business sellers go bankrupt, uh, they will be replaced. Like they're not the ones that are going to get hit the hardest, but hey, sometime in 2025 they could definitely get impacted. Out of these companies, Ryan, we'll move on to another earnings here. Meta, Amazon, Google, TSMC, Microsoft. Which one interests you the most to buy the dip on?
Google, I guess. Although this morning they were ruled an illegal monopoly on
With the ad
advertising.
exchange? Yeah. Good thing that business is it's like $30 billion, so it's not meaningful to the company anymore. But yeah, unfortunately,
Oh,
antitrust is coming for them. They look cheap.
yeah.
The cloud keeps growing. I might say TSMC. I might. It doesn't look that expensive here, and they are de-risking from good old Taiwan, at least a bit, and they should
Yeah.
for the rest of this decade.
They're investing pretty heavily in their US f- uh, location, right? I don't I was going to call
Yeah,
it a
they're
fulfillment center.
committed. So the original commitment, I believe, was 60 billion, and they just upped that to 160. So they're building out a ton of facilities in the United States, and not in 1 year, but a multi-year plan. I think it might have been through 2030, but either way, a ton of facilities in the United States. You
He
want to move
was
on to American Express, or
in
yeah?
in a sec. I read part of the TSMC conference call, and at one point they were like, the analysts like, are you talking to the countries? Are you talking to Trump and
They
Xi
should be the
Jinping?
ones in the middle.
And he's
Uh,
like, well, we're a private company, and those are countries, so certainly no, we're
One
not.
country thinks that we aren't even a country, so I don't like,
It,
like I don't know what the heck they would even do.
he
But
shut that down pretty quick. Yeah. The
those earnings calls are not fun. Honestly, they're not productive. They're too mysterious, and they just say, "Well, things are going well," and then they repeat the questions over and over. So
yeah, I mean, it seems the results have been phenomenal for TSMC over the decades, and you basically have to trust the results. The results and any sort of qualitative slash scuttlebutt that you can get about their manufacturing advantage, you just kind of have to take it at face value
yeah,
because
I
you're
would
not.
listen to the or go ahead.
I was gonna say you're not going to get like. I guess it just shows up in the orders, shows up in the numbers.
Hmm. I would listen to the Acquired episode. Goes over the great history and how they built their moat over the long term. I'd also look at how much Intel is struggling. It's their loss is going to be TSMC's gain. Now, why don't we go through even the numbers here from the TSMC report now that we're on it? 35% revenue growth in US dollar terms, 49% operating margins. Quite the operating margin for a manufacturing and packaging business. They are greatly increasing their investments in the United States, which they mentioned, and they are reportedly increasing prices by 30% in the United States for 4 nanometer nodes. And the last thing, and this is where I think I get a little bit nervous, but also there's just so much potential here, where 59% of their revenue in Q1 came from high performance computing, which is cloud, AI, supercomputers. This would be stuff that, not smartphones. So that's different, but this would be Nvidia orders, Amazon, AWS orders for their custom chips, Google orders for Google Cloud and all that good stuff. Uh, that is doing so well at the moment. But if the AI data center slowdown happens, I wonder, does the next few years feel a bit difficult for me to maybe model out? I'd want to be conservative if we're at kind of a near term peak in spending there.
Yeah, I think it's still a cyclical. I don't think that's too controversial to say. If especially with AI, if high performance computing spend slows, and because I mean the semiconductor industry was kind of saved by that in general. There's already been sort of a cyclical downturn for a lot of the kind of other businesses, Texas Instruments, for example, analog devices, any of the more analog chips, they've been affected. If high performance computing is affected, they're kind of at the cyclical downturn in both. So yeah, I imagine those are also higher margin for TSMC.
Probably. Yeah.
So yeah, timing wise, it could be a little rough. But what do you think? I hate to talk tariffs because I know we were asked not to do it. Do you think the tariffs have potential impact on the data center and AI spending overall?
I'd guess no because they got the exception right now, but I'm gonna put that in the too hard pile. I believe semiconductors got a what is it called? Reprieve exception, but there are maybe inputs to these products that could also be tariffs. So it's a whole mess. And yeah, sure, any company that is shipping physical goods across borders right now is at risk because you don't know what's coming next. You don't know what's actually going to be applied. It's a whole chaotic mess. But this is where the moat of TSMC comes in because they just put in an article, or they must have leaked this, or someone found it out, that they're reportedly raising prices by 30% for their 4 nanometer nodes in the United States. No one else in the world can produce these chips except maybe Samsung. I'm not exactly sure. Maybe that Chinese company as well. So when you have this monopoly, okay, what are the customers going to do? Is Nvidia going to say, well, I don't know, we'd love to have 80% gross margins, but I guess we'll have 70%. I don't know, we're not going to buy from you. Like, they have to go here. So that's where over the long term, I've always thought, yes, there's the geopolitical risk, but TSMC ignoring that is just the best risk reward in the entire industry.
Yeah, I think that's fair. And it is not that expensive, the stock, assuming that the high performance computing doesn't get demolished.
Yeah, and
On
they
trailing
still
numbers,
think,
it looks good.
yeah. We have another question, Ryan, and I think this one's easy, from Randy. Says, are you guys still bearish on Boeing? They did get the new fighter jet contract, and I saw somewhere that the average plane is 15 years old. I want to like Boeing stock, but management stinks. Yeah, it should be a good business, but they do get in their own way. No, no. Stay out of this one. It's a geopolitical football. They sell a lot to China. That might be going away forever now. Who knows? and they can't seem to get profitable in the good times. So there's easier hurdles to get over. Which, speaking of which, maybe American Express, Ryan, another solid report.
Yeah, I'll just add to what you said. Are we still bearish on Boeing? Yes. I am still bearish on Boeing. I think it's going to be a long time but before they are like cash flowing again, like
Yeah.
at a reasonable rate. Because now you've got like, let's say there were no more supply chain. Well, supply chain's a different thing. There were no more manufacturing line hiccups, which they are still getting slowed down by the, what is it, FAA, that's
Mhm.
come in and kind of put a lot of red tape on different processes. Let's say
Probably
that,
for good
yeah,
reason, given that
let's say that
screws were falling
became
out.
ultra efficient again. We're talking 2018 level like production. I think that was when they hit their peak in terms of unit or number of planes delivered. You now are paying your everyone that basically went on strike. You're paying them what, 40% more in 2 to 3 years.
Yeah, over a multi-year period. Yeah.
It's just hard. I feel like it's hard to really and okay, it'd be one thing if you're like, all right, they get back to efficiency, everything's perfect, manufacturing, they're delivering as many planes as they were in 2017, 2018, and they're still able to squeak out good profits even with the increased cost for all the factory workers, and it's cheap on that assumption. It's not cheap. That's the craziest thing.
Yeah.
It's
Yeah,
priced
it's
like
not
all that's going to happen, and they're going to start cash flowing again. And yeah, I just don't see anything attractive about it, to be honest.
easier games to play. Easier
Yeah,
games to play for sure. Comment here from Tyler says the aircraft leasing businesses have the unit economics or the aircraft economics without the operational issues. Yeah, if you look at AirCap Holdings, I know a lot of smart people that own this one. Just looking briefly here, PE ratio of 9 seems to be well run. Yeah, if you like that industry and you see the growth, you want the growth of that market, why not play somewhere else? Well, it's stuck. American Express, Ryan, highly impressed by this quarter. Total billed business, which I believe is just like payment volume. It was up 6% year over year, but there was minus 1 percentage point because of the leap year. So I think they would have been 7% because they're comping last year with the leap year. Saw 14% growth from millennial and Gen Z customers, and they make up a large percentage of the customer base now. 13% growth internationally, 18% year over year growth in card fee revenue, and 3.4 million net card additions in the quarter. You're sharing the screen here, Ryan. I was going to share the PE ratio with our friends at FinChat, but yeah, you can look at that cards in force there. We've seen a nice inflection with their new business strategy, and it seems to be working quite well with a long runway ahead here. But I have the PE chart pulled up, not shared. Ryan's got something else. It is 18 on a trailing basis. It's not too far off from the long-term average. It's not dirt cheap like it was at the end of 2023, which would have been like fall 2023 when it looked like it was at 10 to 13 times earnings. But my thinking is in a recession, and maybe I'm thinking too simply, this is the perfect stock to buy and have on that watch list.
I like it. Yeah, I like it here. The average card fee, so the price people like Brett, who I believe is an American Express card holder, are
That's
willing to
correct.
pay to have the cards has increased at 12% a year for the last 5 years, and it's currently, I think year over year, average fee per card is up 13%. So
Yeah.
they continue to, and I know they tend to increase the value in relation to it or some of the rewards that people can get with it. But yeah, increasing, basically doubling your prices over 5 years and having a resurgence essentially in card holders, especially skewing younger, I think is quite impressive. And it also goes to show that you're attracting probably more attractive customers given how much they're willing to spend on to hold your card. That
Yeah,
or
the millennial and Gen
fakers.
Z are important because they have hopefully big lifetime values where their boomer cohort is not really growing that much. But think about it though, it's still I think it was up 1% year over year. Given that there are a bunch of those are aging out and spending less, that's still quite impressive. I will say you're probably very happy with American Express because they have very robust KPIs that they offer from their investor relations team. The last thing I'll add here is, and they haven't confirmed this, but the rumor is that they're upgrading their flagship platinum card. It would be right around sometime this year, and that's the very expensive one with a $700 annual fee. That is probably outside of obviously the macroeconomic stuff that could affect them in the near term. How they manage that upgrade and whether the fee bumps up to $1,000 or whatever, that's the most important thing for the year, and that's probably the one thing I'm gonna be watching as an investor, along with the net new card additions. I think above all else, the net new card additions is the most important KPI to track.
Yeah. Yeah, that's probably going to be I can't think of any other one that would be more important. Average fee per card, not really. I mean, as long as that doesn't I see no world in which that goes down over the next couple of years. Um, yeah. If they're adding more card holders, there's ripple effects across the business, right? So
Yeah, and,
it all
I
starts with the
forgot
card holders.
Yep, and I forgot to mention internationally, if that's growing faster than the overall business, it's another thing that they've been working on to, get outside of the North American market and really, hopefully get the same distribution as Visa and Mastercard over the long term. So seeing that number grow, I thought all around rock solid quarter end. They're one of the best capital returns plays, dividends, buybacks every quarter. It's just a rock solid company and really right at the top of the watch list. I'd maybe too greedy, and I wanna buy it at a cheaper earnings ratio, but I guess I'm gonna be patient for now.
And that's 18 times trailing earnings.
Yeah, yeah. It's not bad, but again, I think it's one where the earnings are gonna get hit in a downturn, so
You know what I'm tired of? I'm so tired of and this has been happening for probably the last 2 months. Someone pitches me a stock, someone talks about earnings, and in my head, I'm thinking, well, how did the tariffs hurt them? Like, I
Yeah.
wonder if it's a better strategy to just be blind to it and just pretend all this isn't happening.
Uh,
Because honestly, there's a
I don't
chance
know.
that 2 years, 3 years from now, it's just in the past and there
Yeah,
hasn't
there's
been
also a
forward
chance
implications. Yes, I know.
there's also a chance we lose Federal Reserve independence, so, like, there could be some downsides over the long term that maybe investors need to be aware of, but you could be right. I think I more look at it as trying to find companies that won't be as exposed directly over even if they do occur.
But I'm thinking if that if the doomsday scenario plays out where everyone has kind of that seems to be worrying people, which is like total trade war, Federal Reserve loses independence.
Well, it's happening. I mean, it's the path is going. It has been going over the last 2 months. So yeah.
How many businesses are truly unimpacted by that? Like, I think
Mm,
everyone's impacted in some way, probably.
Yeah, so that's what I mean. Not gonna get killed by a coupon. Uh the Mexican airports,
Mexican
other
airports, tourism would drop. Consumers would be
well,
American
I'm seeing
consumers would be
them
screwed.
I'm seeing that some reports and we would have to see the actual numbers, but a lot of the European and Canadian clients have been switching their vacations from United States to Mexico. So that could be beneficial.
Okay, before we move on, I do want to talk about Blue Chippers Club. Blue Chippers Club was started by two friends of ours with the goal of building a tight-knit community of stock-focused investors. Inside this community, everyone gets to share and break down their own portfolios, pitch stocks, receive feedback, and can participate in weekly calls. I want to stress that the weekly calls are fun, totally, obviously, totally optional, but you get to actually rattle off ideas with people face to face, which I think can be really helpful, especially in kind of turbulent times. And what are people seeing? What kind of opportunities are people finding that are attractive? I've been getting a lot of value out of that. So I recommend checking it out. It's bluechippersclub.com. The link will be in the description.
I put some
Once
stuff on
again,
there.
yeah,
Let's see. What was the last one I put on?
Airbnb,
Ooh,
right?
well, I put one why I bought shares of Airbnb. That was a fun discussion. A lot of comments on there. There's written stuff as well. It was quite fun, and I've seen a lot of listeners join. So get on there, join. It'll help you become a better investor.
Yeah. It's a much more like truly tight knit community than what you get with a lot of the general social media platforms. Where do we want to go next? Ally, I think, is maybe not that exciting or sexy, but there was some interesting kind of commentary from the
Yeah.
CEO about, sorry, I know no one wants to hear the T word, tariff implications. So, whatever, quarter looked fine. Net interest margins ticked up a little bit. Net charge-offs ticked down a little bit.
Don't worry. This year is the one. This is the turnaround year. Don't worry. Don't worry. Not then next year they're going to say the same thing.
Yeah, it is kind of, it feels like Groundhog Day a bit with them every quarter, but there was a question around tariffs from an analyst. And first of all, I really appreciated the fact that this guy did not you see this so much where analysts give the answer in their question to sound smart and then ask the question like, why is this going to be the potential implication of tariffs and how do you feel about that? And it's like, this guy just asked, how's your business going to be impacted by tariffs? Which I just thought was a very refreshing analyst question. Anyway, so CEO said, essentially there's going to be two things. First of all, he thinks near term there's going to be a pull forward in demand. Keep in mind, and when I say demand, for anyone that doesn't follow Ally, they're a big auto loan originator. So basically, he's saying a lot of people are going to go out and try to buy cars today before the tariffs start to impact the prices. And he said they are seeing heightened volume, or they saw heightened volume kind of towards the end of the quarter there and in the last couple of weeks. So he said that is playing out to some degree. Long term, he gave what most people think would probably happen. He just said, we're going to originate loans on fewer units because the prices are going to be much higher. I think the stock probably traded off because of that, because the other results looked all right. So I think it dropped like 1 or 2%, but
Maybe volume would be same from a dollar perspective if you're thinking optimistically.
yeah, maybe. But I'm seeing this in every conference call I read. We don't know what to do yet. Nothing's changed. We don't know what to do yet, though. Like, it's just
Not
this,
good.
like, everyone's in limbo right now.
It's not good. It's not good.
Schwab's cash as a percentage of client assets has ticked back up this quarter. They reported this morning as well. It's not like 2022 levels, but I think it's the highest point in the last 18 months.
Yeah. With Ally specifically, I mean, they can survive if volumes are a little bit lower, but the key thing for me is just write-off rates, delinquencies, and right now that looks strong, but I mean, if we see, for example, there's been a whole narrative this week about how, and I mean, not a narrative is probably right, where a ton of the safety stuff you buy for a kid, like strollers or car seats, those are getting double the price, and you buy a nice car seat, and now it's $600 instead of $300. And these young families that might be purchasing a car, okay, you have this car loan. Well, yeah, you get the picture, like write-off rates, delinquencies, 30 days past due, they could start rising, and that's going to be the most important thing for Ally over the long term, as well as on the other side of the business, attracting depositors.
You know who's experiencing absolutely zero recession? Hermes.
Yeah, the true luxury business, Ryan. Really, that episode we did with Leandro from Best Anchor Stocks, who's been doing some great work recently. Check out his podcast with Ryan O'Connor on Nintendo. That was quite good. And then also with Sleepwell Capital, that one on the true luxury businesses we did back in 2022, it's aging quite well because we're seeing how LVMH, as you're about to get into here, and Hermes, very different trajectories the last few years.
Yeah, I don't know if I can think of any business that's more untethered to like economic conditions. Like people will buy these Birkin bags no matter what. Is kind of what I've come to. And so leather goods and saddlery revenue was up 10% year over year. If you look at Hermes versus LVMH, which Brett is sharing the chart right now, over the last 2 years, LVMH, which is considered a luxury brand, and some other luxury brands have been worse off, by the way. There's other ones that have really gotten hit. Their revenue is down 6% cumulatively over the last 2 years. Hermes up 28%. Like when people are buying a $20,000 handbag, it's just the type of customer that isn't affected
Right,
by
conservative balance sheet. They got a lot of liquidity. They
yeah,
got all this stuff that they can manage through a downturn. It's not going to affect their spending habits.
yeah. And I always kind of thought the luxury argument was weak for like a long time. I was like, yeah, okay, if there was a deep enough recession, everyone would be affected. I honestly think because Hermes doesn't like they somewhat restrict supply, I honestly believe them and Ferrari would not be impacted.
Right. Yeah. Yeah. One of the key tactics from both Hermes and Ferrari is restricting supply and putting the selling prices significantly lower than the resale prices. So you know that you can consistently raise prices without impacting customer demand. And that just leads to steady revenue growth. It's a very basic strategy. Now, they could, for example, put up their prices by 50% in 1 year. Customers might be angry, but they'd still buy that. But that maybe ruin some of the brand value. But consistently raising prices, that's it's nice. It's not bad.
And they
It's good. And
and something they do is that they make whether this is like accidental or intentional, and I think it's probably more intentional than the former. They make the customer feel like it's an honor to buy their goods. Like
yeah, exactly.
the Hermes, that story that came out that they're being sued for discriminating against someone who they, I
Poor
guess,
people.
yeah, discriminating against poor people, like they wouldn't let someone buy a Birkin bag. That's incredible PR for them. Like,
Yeah, it's almost like the exclusive country club that you wanna be a part of,
yeah,
and Ryan, I don't know if you saw this, but there were those videos going around where, as a part of, I think, the trade war, these Chinese manufacturers are essentially exposing that it costs them $1 to make a Lululemon pants, and that are sold for $100 in the United States, and they go, "See? Look at this, $1," you know? And LVMH has not been, how would I say? They're exposed to that because unlike Hermes, they, for cost purposes, diversified their manufacturing around the world. Hermes, all of their bags are made by handmade artisans in France. And that's part of that brand quality as well. And it makes it more durable over the long term.
yeah, yeah,
But are you
absolutely.
buying it at 50 times earnings?
No, yeah, the price is ridiculous. All right, a couple others that I want to talk about. I know you're going to talk. I know we're going to do a deep dive on interactive brokers in a bit, but is this the unsung compounder of the last decade? Like, I don't know if there's like this should be the compounder bro stock.
Yeah, Luis Sanchez, guy that came on and did MedPace Holdings. What is it? LVS Advisory. He pitched it. It made sense back then. And full disclosure, I did buy it this week. I just felt like, hey, buying on the dip. Their earnings might get hit this year. Who knows? There's a lot of things, as we'll talk about in the deep dive, that can impact their short-term revenue. There's just a bunch of puts and takes, tons of KPIs to track, and as well as net interest income. the customer accounts have just compounded year after year after year after year, and they just have a better business model where on Schwab, for example, that's the place that Ryan and I used to use, you're limited in your trading. And IBKR can offer much more as well as the same stuff that Schwab offers. So why would I go anywhere else, especially when they offer, as you know from our advertisement, 3 almost 4% interest on their cash. They've managed the interest rate cycle much better than the competition. But let's go through the earnings. Commission revenue was up 36% year over year, driven by stock trading. The majority, so it's not, I would say, a little bit better than the exposure that a Robinhood has to options or crypto. They had net interest income up 3%, but they are guiding for that to get hit if interest rates fall. 74% pre-tax profit margin, very efficient business, quite an efficient business, and 32% year-over-year growth in customer accounts to 3.62 million. My question is, and I know this may be dissuading people from going into a deep dive in this business because that's what we're going to do, I think, not next week, but the week after. It feels like if you just track customer accounts, that's literally the only thing I need to see each quarter. And I know that's going to be fine.
Yeah, it's probably the same, similar to like American Express in that sense. It- The thing, the thing I love about IBKR is, and I'm making some assumptions here. I assume they've gotten a little more aggressive in recent years with some of their marketing, just
Well,
because of
they're
the
advertising on a mid-level podcast.
well, yeah, and it looks like they have. I mean, marketing or SG&A in general has gone up, but for the years leading up to the interest rate hike, they it's like you can there's two different stories. You look at Charles Schwab, you look at Interactive Brokers. Charles Schwab, it's not founder led. It's no, there's a lot of incentive to do things that benefit you in the short term from management's perspective. They continued to push the duration on the assets they were buying, while Interactive Brokers said, no, we're not taking the risk. They just kept rolling, like I think it's 30-month treasuries or something like that. They just kept rolling 30-month treasuries. When interest rates spiked, Schwab was almost like for a while there was some genuine bankruptcy concerns for Schwab. That didn't happen because everyone thought there was going to be withdrawals. It didn't occur. Schwab's fine. But that's allowed Interactive Brokers to press the accelerator. They have now been like those assets that Schwab had that were 5-year, 10-year, probably weren't that long, but long duration assets are now worth significantly less in a higher rate environment. And Interactive Brokers gets to continue rolling their treasuries at higher rates. And now they're getting aggressive, being able to add more accounts and kind of capitalize on their good positioning. And we're seeing it. That chart I shared here a second ago, they added over the last year, let's make sure I get this number right. Last 12 months, they added 870,000 accounts. That's far and away the most accounts they've ever added in a 12-month period. Like even 2021, when equity markets were soaring, they added more than that. It looks like they added 50% more accounts than they did that year. And it's not like this is like the perfect environment to be adding new accounts. Like you're not necessarily seeing this out of the other brokerage platforms. So it is really like genuine flexing their competitive advantage.
Yeah, and just having all the assets available to be traded like you would if you were a giant investment fund. I mean, at least most of the stuff that you'd want access to, and having that available for individuals, it's something that gives them economies of scale, and you can just keep pressing that advantage. Now they're adding stuff like cryptocurrencies. I think cryptocurrencies are nonsense, but the company can make money off of that. You're adding things like bonds. You're adding things like all this foreign exchange stuff, which they've had for a long time. You're adding things such as betting markets. You just want as many things on the platform as possible, and that's just going to separate themselves from the Vanguards, the Fidelities, the Charles Schwabs that just, okay, when you're on there, you can buy US stocks. That's it. Or you can buy some ADRs. And if you're trying to do stuff besides that, unless it's in an ETF wrapper, you're going to have such a hard time. And that frustration just gets totally alleviated when you're on IBKR. And I just think more people are going to switch. And it's not going to be an immediate thing because, as you are well aware, as I'm well aware, we just did this. Switching to a new brokerage takes a lot of steps. You have to get things validated. You have to do this whole procedure. It's not easy. And there's a lot of friction from, or just lethargy to switch brokerages, similar to switching a bank account. But over the long term, I think they can just continue to add new accounts. Why can't IBKR have 20 million accounts at some point, right? There's plenty of people out there globally, right? And it's
Yeah.
great for the US investor, but internationally, they are pushing in so many new markets to offer global exposure for, say, someone that lives in Costa Rica, where there's basically no stocks to invest in. So you have that exposure to go to the United States, Europe, Japan. It's a good business. I think I'm sounding excited about it. I am. And the PE, yes, it can be cyclical, but it's not too expensive.
They've played the long game too. They were not. We saw a lot of brokerages get in trouble. Robinhood got about as aggressive as you can possibly get. Schwab got aggressive with the duration. Interactive Brokers has just been steady, consistent execution over what? I think they've been around for like 30 years
Did
and
you know that
still founder led.
yeah, I think so. Yeah. I
Thomas
didn't see him on the
Petterfee.
conference. I didn't see him on the conference call, but I guess he's kind of one of those the Bezos style, like, yeah, I don't need to be on here, which I think is always funny. But did you see, Ryan, that Webull? Maybe I should have added this to Bubble Watch. Webull went public. Ticker symbol Bull, Bull.
Could not have got a better ticker. But yeah, I did see this. They went public via SPAC, right?
Yeah. We might go low. I don't know. This might be a bear market rally. Webull is going public.
We should take a look at their financials. Just
That
see
would be
what's going
a
on there.
small cap of the week. It's probably already a small cap.
ASML, we've got a little over 5 minutes left. ASML reported this week. This was their second ever largest quarterly buyback. I think just over 2.5 billion. That's like there was one period, I think in 2021 lows where they eclipsed it. Any interest? Go through some of the numbers.
Yeah, I will say I'll highlight Leandro from Best Anchor Stocks, the Best Anchor Stocks newsletter. They actually did a coverage of the earnings that was free to everyone, so go check that out. He did mention, he's been someone that's following this company a long time, that the buyback is not necessarily a smart capital allocation decision from management. It's more of their philosophy is if we have excess cash, we're going to buy back. If you look at the historical record, so the fact that the stock is down, it's kind of just lucky, but they haven't shown much intelligence of buying back when the stock is cheap. Although I won't, hey, if we're going to just return capital to shareholders, I would want the stock to be down. If we look at the earnings are always going to be lumpy. So just looking up their long-term guidance can be important. And they really reiterated that 2025 net sales are going to be within 30 to 35 billion euros. They are expecting 2026 to also be a growth year. And by 2030, they are expecting between 44 billion and 60 billion euros. PE trailing Ryan, and I know we've been quoting PEs a lot. Again, we do more complex stuff for valuation work, but this is just shorthand for the discussion. PE is 25.5. Yeah, I see you kind of doing the head shake. Kind of interesting here. Maybe.
Yeah. And you know what? Even though we said it was just kind of random for them to buy back this much stock this quarter, if we go EV to EBIT, they are trading at This quarter they traded at basically their lowest EV to EBIT valuation in 6 years.
Not bad.
So, well, we'll see what the forward numbers look like, but my guess is that was probably fairly timely. Um, I also like that multiple better in general than the PE. So 20 times EV to EBIT for this business, which I believe has a phenomenal moat. I'd be lying if I said I was any sort of a expert on uh, lithography technology, but it seems like no one has been able to replicate what they do. Uh, yeah, I think that's actually a pretty attractive price. I also believe like a single system goes for like $170 million or something like that.
Yeah, and they're upgrading, so that's going to start growing, I believe, because they're shipping more of the high uh, EUV machines, the ultra lithography machines, whatever it's called, as opposed to the ones that they had previously. So they have an upgraded version that are going to cost more for customers. Yeah, I mean, the biggest risk for them could be a little geopolitical selling to China. Who knows? In that regard, but it's almost just the innovation risk where someone comes up with a new method. Hey, maybe lithography is less important over the long term. But from what I've read, of course, there's going to be innovation risk for any business. And you have a company that's generating a lot of cash now, returning the cash to shareholders. We're going to see, hopefully, the shares outstanding start to drop. And there is a path to durable revenue growth through 2030. It's going to be inconsistent each quarter, but hey, yeah, I could hear the arguments for buying ASML here.
Yeah. Okay. As we wrap things, I agree, by the way. As we wrap things, OpenAI is building a social network.
It's going to be called slop.
According to The Verge, wait, tell me that was a joke.
No, that is a joke. Yeah, I don't know
Okay.
what it's going to be.
All right, thank God. It's telling that I could have thought it was legit. OpenAI is working on its own X-like social network, according to multiple sources familiar with the matter. Thoughts? Okay, thoughts A on whether or not this is worth the development time, but B, would you join this?
No, why do I need? I don't even like any of the AI stuff. I don't like. Why do I need to see AI videos all day? And maybe you could say, well, you're seeing that on Twitter, but no, I think OpenAI, Altman needs to set aside his personal grievances and his little war he's going at with Elon Musk, and he needs to separate that from his business because there's no reason to do this. I think it would be a complete failure, and I have high conviction in that. Yeah. I mean, Elon Musk has done a lot to try to convince people, at least of with certain beliefs, to leave Twitter, and they have, but people are still there. Even though you get 20 spam bots every time you post.
Yeah, I do think he's leaving the door open for someone else to do it. I mean,
If the door's open, it's going to be Substack. It's not going to be OpenAI.
I am open to other social platforms more so than
Yeah,
I would have been 6 months ago. I would have had the exact same take as you.
so am I. I'm more open too. Substack, we have the chat community on Substack, blue chippers post in there.
I mean,
But
not that like I'm sure a lot of people don't care, but the bots problem on Twitter is outrageous. Like there's it's just a news feed at this point. There's no like real conversation going on the platform anymore, it seems. I
uh,
would love
there's
like
conversation. I
I
have
think
conversations all the time.
I just think it's been crushed by this onslaught of pointless responses. The, this once again, a shout out to blue chippers because I've like have such more thoughtful conversations on there and get
Yeah,
valuable comments. The what do they call it? Noise to signal ratio. A lot more signal.
I agree. I agree. Yeah, I'm
But
not
yes,
saying
this is
I'm
probably
not
a
saying I'm a fan of Twitter, but I think I doubt OpenAI. It's a different muscle. Think about Google back in the day. They were like, why can't we beat Facebook? Well, it's a
true.
different muscle. It's different. It's a whole different game.
Yeah. It
All right.
requires focus, a company's focus.
Yeah, and it's just different. It's a whole different skill set from your developers, your whole team. All right. Well, it looks like we're coming up on an hour, Ryan. Anything else before we get out of here?
Nvidia was charged 5.5 billion.
Or they take a right? Was it a? They
Yeah.
took their own charge or something
Yeah.
for getting banned from selling something in China. Yeah.
Stock sold off on it, but yeah.
Yeah.
You know what? I I'll just never be a Nvidia shareholder.
No,
I've
I'd
kind of
rather
come to
buy
that realization.
TSMC.
There's no and the I have nothing. Management seems phenomenal. The business seems great. They seem to be in the top position, but I'd say it's out of my circle of competence.
Yeah, I have no interest in owning it. It's all right. It's been a 100 bagger for others. You take those gains, guys. It's not for me. Okay. I think that's it. Thank you, everyone, for joining. As a reminder, if you're listening to this, we're releasing this on Friday morning, but we are recording now at 5 p.m. Eastern Time on Thursdays, releasing them Friday mornings, changing it up, trying to be a bit quicker and making more room to get the full news and earnings of the week so we can talk about them without getting stale. All right. As a disclosure, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for joining the live episode, and we'll see you next week.